name is Henning Straeter, partner and head of transfer pricing at Nexia in Germany. I'm excited to welcome my partner colleague Nick from the US to this podcast today. Dear Nick, could I ask you to briefly introduce yourself?
Yes, good morning, Henning. I'm Nick Carofano. I am head of the US Transfer Pricing practice at our CohnReznick/Nexia firm. Pleasure to be here. I look forward to speaking with you.
Thank you very much. Dear Nick, what I'm interested in, and I think the audience will be informed about this, how did you end up being a transfer pricing expert?
I appreciate the question. Thank you very much, Henning. My path to getting interested in transfer pricing started with being a practicing tax professional. I specialized in international tax, and a few years ago saw that transfer pricing was going to be a very important tool that multinationals could use. And I was very interested by the fact that transfer pricing marries not only taxation and transfer pricing, but also looking and evaluating at business processes and business organizations. And that's how I decided to specialize in transfer pricing.
Oh, that's very interesting. Thank you, Nick. My second question would be, how does transfer pricing affect international business operating in your country?
That's a great question, Henning. I know you and I have spoken at conferences and individually, and I think it's great for our audience to understand. From our perspective, transfer pricing impacts all aspects of our clients' businesses. It impacts the planning phase of not only transfer pricing, but also international taxation and other business aspects of optimizing business processes and cash flows and taxation. But also these days, what is becoming very important is the actual execution of intercompany pricing, how to set prices, how to monitor them, the impact on the accounting function and reconciliations and monitoring. It's becoming very important with the age of digitalization and technologies evolving. And also then we come to the compliance aspect of transfer pricing. Our clients need the assistance to help prepare reports or benchmarkings or just evaluate the results of their intercompany flows against their policies and against their goals that they planned at the beginning of a particular year. Then the last aspect of how transfer pricing impacts our clients and businesses in the United States is also the controversy aspect of it, where tax authorities, not only the IRS, but other countries around the world, will scrutinize the results and the intercompany transactions and arrangements. So it impacts the full transfer pricing life cycle of our client base.
Yeah, great. Got it. And you spoke about the US. Of course, you are the expert, the transfer pricing expert in the US. We saw a lot of development in the US, especially with the election of the new president. So what our clients and audience would be interested in, could you describe the most important development in the local transfer pricing regulations in the US, especially for the year 25? And the second point would be, what local regulations can we expect in 25 that may affect international business?
Yes, that is a very interesting question. As our audience will know, we have a new regime in the United States, a political regime. The Republicans won, and the leader of the Republicans is Donald Trump. Donald Trump is a disruptor. So having said that, I'll address that point in a couple of minutes. I think the first thing to understand is there hasn't been any technical changes in the transfer pricing rules in the United States. There has been some guidance in a few areas, and I'll touch upon those first and come to the implications of a Trump presidency in a moment. The first thing is the enforcement aspect of transfer pricing, and the IRS has taken a view. They had received significant funding a few years ago under President Biden, and they did put some money in enforcement of transfer pricing. The implications for our audience is that the IRS is focusing on some low-hanging fruit. That means that they're focusing on looking at tax forms from tax returns that are filed and identifying U.S. inbound distribution companies. Generally, the more simplistic, less complex structure where the U.S. entity is just really buying and reselling. However, the IRS has discovered that a lot of these inbound clients actually generate losses or very, very low returns. And so the IRS has made a point of sending out actual letters to inbound multinationals in the United States where they've identified either very low distribution returns at the operating margin level or losses. And losses can be 1 year or multiple years. And they have sent them out letters saying that their transfer pricing is incorrect. It is not arm's length, that they should go back and make adjustments to their profits for past years, and that they are now on the radar if changes are not made and the IRS revisits their returns and still continues to see losses. That is a very significant change, especially with the letters being received. In our client base, we have 3 clients that have received that particular letter. And it's throughout the country. It's not in one particular state. So that has put our inbound multinationals on alert when they are aware of it. So that is a big, big change in terms of the enforcement aspect in the United States. And our clients need to revisit their transfer pricing policies and results, not only on a single year basis, but a multi-year basis to ensure that they don't continue to carry the exposure. Having said that, there are cases where losses for distribution companies may be acceptable and deemed arm's length. Those cases are where you have a U.S. company trying to penetrate the U.S. market in the early phases, so a startup phase, or there's an introduction of a new product or category or segment where they need to spend a lot to gain market share. And as long as the characterization of the U.S. entity is maintained throughout its life, those losses could be supportable. However, there is information that is needed when we prepare our transfer pricing reports, Henning, to have them in the reports in terms of proving the amounts and the implications of those costs driving the losses. With that come the expectations that over a multi-year period, the IRS does expect a U.S. inbound to become profitable. And then the discussion becomes, well, how much profit should it be earning because it made such a significant investment in the past to generate losses? And so our clients really need to think through and revisit their operations in the United States and compare to their policy and determine whether there should be adjustments to the U.S. tax returns or taxpayer in terms of returns. The other, go ahead, Henning. Go ahead.
Please go on.
So that is one sort of change in the environment where we're talking about enforcement. The other area of change potentially is we have the OECD introducing Pillar 1 and Pillar 2. I think everybody is starting to understand the implications of that. Now, having said that, Trump has decided not to participate in the OECD, but we don't know exactly how that is going to transpire, whether it's some type of negotiating technique or something else. We just don't know. However, there has been a Notice 2025-04 in the United States where the IRS has put out for commentary the adoption of an election for distributors in the United States to follow a safe harbor. They call the simplified and streamlined approach, where if a taxpayer in the United States elects in a timely filed tax return to adopt the safe harbor, it would mean that distribution companies in the United States, and there's a certain criteria to meet those terms, would be able to elect to earn between 2 and 3 or 2 and 3.5% of sales as an operating margin return. So that is out for commentary. They are asking for comments by March 2025, and I am sure that the IRS is having fun trying to determine what Trump will do with the OECD as well before any adoption of that guidance comes into play. So that's another significant update in terms of where the IRS is going with enforcing transfer pricing. Now I'll come to the yep. Go ahead, Henning. Please.
Yeah, that is what. Sorry that I interrupt you, because from my perspective or from the European perspective, it is very important to know, because our clients here ask us nearly daily in the daily business how we can react on this development in the US. So. Yes. From the perspective here and from the CFO perspective here in Europe, what takeaway could you give in relation to that you mentioned here in this recording?
Yeah, the new environment. Well, not really new. It's just the enforcement, right? And I think the big takeaway for our CFO and C-suite, not only CFO but all business leaders, is that transfer as a multinational, their intercompany arrangements need to be, we like to use the word scrubbed. Are we aligned with the policies of these arrangements that were set out? Number one, is it something that a multinational should strive and say, well, I don't need to elect under the new notice, but I can arrange my affairs where I can leave those types of 2 to 3 to 4% returns in the United States without having to do an election, and take away risk off the table in terms of having those inbound operations attacked or scrutinized by the IRS. And so the big takeaway is that international tax issues and transfer pricing globally, and in addition in the United States, they should be reviewed and monitored, and any changes that can take risk off the table yet be aligned with other objectives such as tax optimization, performance evaluation criteria, cash flow implications. Those should all be discussed at the table in terms of modeling out those returns. I think that's the biggest takeaway, that you just can't say, oh, here's our transfer pricing policy, put it in a file or on a shelf, and then walk away without being able to implement it. And I think, Henning, that's where the operational transfer pricing comes into play, where you're taking your policies and actually operationalizing them, meaning you're setting the pricing in the ERP system, monitoring those results, making the appropriate adjustments before the year end, to align with the business and tax goals of the entity. So I really think it's a holistic view that needs to be reviewed, not once every 3 years, but annually needs to be reviewed and monitored.
Yeah, thank you very much, Nick, for your very interesting insight. I totally agree with you, because transfer pricing is not a local potential risk and an effort which should be in line with the compliance. Transfer pricing is international, and here in Germany or in Europe as well, and in Asia, I would expect we have the same situation. So I think that the year 25 in particular will be an important year for international business relation. For this reason, we are pleased to have you here as a competent point of contact for international taxes and transfer pricing in the US. And with your consent, I would appreciate and I would like to mention your contact data, if you agree, in the end of this interview. But what would you prefer? How can the clients and the audience and the interested persons get in touch with you?
Absolutely. And I did want to touch upon the Trump tariffs rather quickly. As the audience may know, Trump had introduced just this past weekend tariffs, significant tariffs at 25% levels for two of its largest trading partners, Canada and Mexico. And so As of today, as we're talking, Henning, you and I, there has been a 30-day pause between the three nations. So tariffs is something that our clients globally need to pay attention to, because if Trump is going to be applying the tariffs to its largest trading partners, one can imagine what it will do with our European and Asian, especially China, counterparties. And so on that perspective, there is no guidance in terms of what will happen, and we need to stay tuned. Secondly, I think our clients likely are, and if they're not, should be modeling out the implications to their intercompany arrangements. Because the implications from an inbound US perspective will be, what if the price of those products coming in reduce the volume of sales and what that does to profitability, and then who and which party should be taking those risks, and planning around likely taking costs out of the system to reduce the value for duty and tariff purposes. And thirdly, if there are operations in the United States, or when we look out, and obviously if Mr. Trump applies the 25% tariff or tariffs, we are pretty certain that there will be retaliatory tariffs in other countries. And so what does that mean in terms of the characterization of the operations in a particular country? If they are fully fledged risk takers, would they consider now converting to something less risky and therefore reducing the amount of profit that can stay in a particular country, potentially? But also that would trigger the consideration of termination payments and compensation for restructuring those operations. So our clients are likely modeling out those implications, and if they're not, they should be. And we see this in the very near term as a real issue that that multinationals will have to deal with. So appreciate that. In terms of connecting with me, as you know, Henning, I am very happy to have our clients, your clients in Europe, to connect with you, to put you in touch with me. If they want to contact me directly, they can contact me at nick.carofano@CohnReznick.com with an email, or they can go to the CohnReznick global site here in the United States to connect with me. I hope that is sufficient, and happy to speak to any audience member.
Great. Thank you very much, Nick. And I would like to thank you and look forward, of course, to our upcoming conversation with additional interesting topics. Would you like to add anything in conclusion, Nick?
In conclusion, I think as you and I, Henning, talk frequently, transfer pricing cannot be viewed in a vacuum. Transfer pricing needs to be viewed holistically with international tax, and as we briefly discussed, indirect taxes such as duties and customs these days. And I think our multinational clients need to look at the international operations and arrangements holistically in that manner, and plan to maintain their business and tax goals in the coming year, 2025, as we get ready for the Trump presidency and changes that he will introduce.
Great. Thank you very much, Nick. And it was a pleasure for me to discuss with you and to interview and have this workout. And I'm very happy to speak to you soon again. Thank you,
Yes,
Nick.
And thank you, Henning. Thank you very much.
Yeah.
Have a great day. Bye-bye.
Have a great day. Bye.